the one key thing to understand with the opportunities in the market is you need patient capital. Patient capital, in terms of the way that we structured our funds, allow us to have dry powder at times when others are seeking to seek out that liquidity. What does that mean? Some of our peers have made illiquid investments, but then on the other side have offered liquidity in their own funds, either daily, weekly, monthly liquidity. We've made very, very careful, with the way that we've constructed our business to make sure we've never been in a position where we have to force sell any assets, even in a normal market, let alone a dislocated market. So what does that mean in this period? As these other funds are forced to sell assets, we find we're not a distressed debt manager. We never will be. That's not our mantra. We're a par loan manager that looks at sleep at night credits. What we do look for, though, in periods like this, and you talk about opportunities, is buying assets that are otherwise performing assets, buying them off distressed sellers at a time where there's not much liquidity in the markets. So that's manifest in the deals we've bought, the transactions that we've bought in our first fund. We've been able to buy in our second fund, because we're monitoring those very closely, at very good discounts to the original face value. So the yield on those investments for exactly the same security that we own in one fund, we've been able to buy, for instance, at 90 cents in the dollar. And so the yield jumps up from being 4.5% up to 6.5%, 7%, sheerly because there is a forced seller for exactly the same asset. And the one I'm thinking of is a mission critical infrastructure services business that we bought at 90 or even lower than 90 cents in the dollar, which means you can get a very good risk adjusted return and actually get a higher yield for your investors in this period with even less risk. And that's the opportunities in the market today.